Hello, everyone. Welcome. Thank you for joining us. We'd like to welcome you back to the ACT webinar series for healthcare professionals. My name is Robin Geiger. I'm the Senior VP, Clinician Advocacy for Ingenovis Health. Ingenovis Health is the corporate and parent company to FastStaff, TrueStaff, US Nursing, Cardio Solution, Healthcare Support, Vista Staffing Solutions, and Springboard Health. Today, we are delighted to have the owner and president of Travel Tax, Mr. Joseph Smith, lead us through tax tips regarding tax home residents and additional tax suggestions and recommendations. Now, it's my pleasure to introduce you to Mr. Joseph Smith by reading his bio. Joseph grew up in Greenville, South Carolina, but after graduating from college and marrying, he hit the road as a traveling respiratory therapist. He later earned an accounting degree, began to gather tax clients, eventually using his accounting degree more than his respiratory therapy degree. Travel is still a big part of his life, but now it is for seminars, consulting contracts with healthcare staffing firms, reviewing their reimbursement policies, and giving recruiters in services so they understand the tax issues better. He has almost completed his goal of having been to all 50 states, missing 4. And it is my pleasure. Mr. Smith, the platform is yours.
And thank you, Robin. And that bio is 4 months old because I did accomplish my 50 states when
Congratulations.
my son moved from Georgia to Oregon, and we did the drive. And I hit every one that I was missing.
That's amazing. Congratulations.
Yeah. So next is all Canadian provinces. What we're going to talk about today is a tax resident. Now, to lay the foundation here, my understanding is that most of you are receiving one of the following, which will either be a per diem for housing meals. You may have company provided housing, or you may be in a situation that you are an independent contractor, 1099, S Corp, LLC, one of those arrangements, and you are finding your own housing and then deducting that. And of course, that only applies if you're an independent contractor, self-employed. But you are all in one of those categories. You may have another category for those of you that are not even receiving it because you're local. But when we talk about a tax home, tax residence, why is that important? It's because we're trying to identify whether you're eligible to deduct your expenses for lodging, meals, and travel as a contractor, or whether you can receive a reimbursement, per diem, stipend, subsidy, or even company provided housing on a tax-free basis. So that's where we are, and I'm going to share my screen here to get us going. And you should have the cover page for the presentation. So I'll give you a little odd side of my background. This is my photo back when I was much better looking in the early 80s. And I was in the respiratory therapy department classes and curriculum.
Joseph, we can't see your screen.
Can't see the screen. Let's see. Oh, there we go. What about now? Can you see the screen?
Perfect.
Now?
Yes.
Okay, good. So back to my better photo. Early 80s, better looking. It was in the RT curriculum. And later on, like Robin said, I went across town, got my accounting degree, and I hit the road traveling after that. And this was my license plate. And it was a great way to start conversations at stoplights. People seeing my Jeep that I had, it was just full of stuff. And then the homeless plate on the back. And I actually still have this in my office as a memento of all those great years. And I don't want to bore you with the other parts of my background. I do quite a lot of work for agencies and the compliance part of this. And I've actually testified in court cases involving tax compliance. My firm, Travel Tax, we do over 4,000 returns for traveling professionals, whether that's in healthcare, engineering, IT, nuclear reactor technicians, and staff. And it's the same stuff. It's traveling related expenses, traveling related tax items. I have two boys. The one on the left just gave me a granddaughter, which sort of looks like a little Buddha version of him. Uh, she's now starting to look like mom a little bit, so we're sort of happy to see that. So why is this so important? Well, there's two reasons. One, if you have a tax residence, a valid tax residence, there's a substantial amount of tax savings involved. It all depends on how much you are making. And of course, where it is that you're working can determine that. But for somebody who has a valid tax residence, we're talking about tax savings that can be anywhere from $3 all the way up to $10,000. And of course, during the pandemic period, the savings were even more pronounced. And as we go through this, you'll also see that you have to compare that to the cost of the home that you might be keeping. But still, it is a significant motivation or incentive for becoming a traveler. The fact that you can receive on a tax-free basis housing, meals, and transportation reimbursements. Now, the other reason this is so important is because you are in a heavily audited industry now. Construction, trucking, healthcare staffing, it has been under the scrutiny of the IRS and Department of Labor, especially in the last decade. In the 2010s, numerous audits and exams of agencies as well as travelers were done by the IRS. And they went so far as to monitoring social media, as well as doing random court endorsed subpoenas of travelers just to talk about their contracts. They did 400 of these in 2015 to gather intelligence about the industry and how it works. And more recently, with the pandemic, we've had a lot of negative publicity regarding the increased wages and the number of states attempting to enforce wage caps on travel and temporary workers in hospital or medical facilities. And this trickles down to the traveler. And it's very important that both the agency as well as yourself stay on the right side of this. Because as the IRS replenishes its staff, healthcare staffing will probably be another focus area. And before we even dive into this, I'm going to establish a concept that pervades all of the tax home laws. And that is the concept of a reimbursement. And this is very important to understand so you can understand all of what a tax home looks like. So let's look at something very simple. Let's just say you have a roommate or a friend and it's Friday night and they're not really interested in going to the grocery store. And your friend, your roommate, whoever it might be, is headed out there. And you say, hey, will you pick me up a couple of items, whether it be some beverages, cheese, or party favorite, whatever it might be. So they say, sure, give me your list. So they go out to the store, they come back and give you the bag of your items. And what do you think they're going to be looking for next? They're going to be looking for you to pay them back. Maybe you did that before they left. Most of the time they come back with the receipt and say, hey, here's the cost. They're going to be looking for you to replenish what they had spent on your behalf. They're going to be looking for you to reimburse them. And the concept of reimbursing is very important when we look at what a tax home tax residence does. Because when an agency pays for your license or uniform or some other expense like that, they are reimbursing you, even if they paid it directly to the provider. like if they paid for a seminar or something and paid the seminar facilitator or the event management firm directly, in effect, they're reimbursing you because otherwise you would have to spend that money yourself. The same holds true when we're talking about lodging, meals, transportation. And whether this is called a stipend, allowance, per diem, subsidy, or any other label, whatever the label is, it is a form of reimbursement, a payment to you to replenish what you had to spend in order to carry out your job duties. And probably one thing to keep in mind about per diem stipends and allowances, and I'm just going to use per diems from this point forward instead of trying to repeat all those other words. Per diems reimbursements are not income. They are expense offsets. So what does that mean? When you go apply for a loan, a mortgage, a car, whatever it might be, you cannot use per diems reimbursements as a part of your income, because they are there to offset an expense that you have. So with that understanding, now we can get really deep into the whole concept of a tax residence. And a tax residence, a tax home, is very confusing. And it's frequently litigated in tax court and other courts. So if you are coming to this with a little bit of confusion and misunderstanding, well, it's normal. It's understandable because of all the confusion that's out there about this. So the way you have to approach this is putting on that ACLS algorithm hat. And for most of us, we've had to do our version of ACLS, PALS, NOWs, or whatever we take. And we have to go through these little Boolean equations, and we have our little cheat sheet that says, is this situation present? Yes, no, then move on to the next one. So when you're talking about a tax residence, it's very similar to this. I'm going to slowly walk you through an algorithm. And the other thing we have to do is put in our minds that home can have a different meaning depending on context. If somebody were to ask me, well, where do you live? Where's home? What do you mean where I live? Or where is my heart home? Because if you were to ask me that, I live in South Carolina, but my heart is in my old home in Nebraska. I love my prairie home. But therein shows you that home can have a different meaning. My boys are adopted, and when we first brought them to America, they were 9 and 10 years old. On the first snowstorm, they went outside and built an igloo and said, hey, this is our new home. We'll just sleep out here for the night. Well, they got tired of that, went in the backyard and built their vacation home using old tree trunks and trees. But then we took them to Smithsonian, and things all changed. They wanted me to buy the old space shuttle so that they can live in that. Again, home had that idea that was constantly changing. So when we approach a tax home, tax residence, we have to consider that home has a different meaning. And the first place that most people stumble is that they think that a tax home and a permanent home, a tax residence and a permanent residence, are all the same thing, but they're not. They are two different concepts. A permanent home, a permanent residence, is a legal question. The question of where is your legal home is being asked there. And typically, when we determine where your legal home is, it's in some ways the holy trinity, if you will, of driver's license, car registration, and voter registration. All of those things sort of point you to a particular community and ties to that community. But that is not how you determine a tax residence. A tax residence under the tax code is considered a regular place of business. So break that down. It's your regular geographic commutable area in which you earn your income. Where does this person make their money? Not where they live, but where do they make their money? Where's their money home? Not where is their legal home, where they lay their head. Where do they make their money? That is what a tax residence is. And the area, geographical area, is not a state. It is a particular community that could be on the border. So let's say you live in St. Louis. That includes Western Illinois, because once you get over the bridge, you're into Western Illinois. You could work in both places and still be in your tax home area. So a permanent home, tax home, different things, even though they're often in the same place, which adds to the confusion. Now, I've been a college instructor. I've taught tax and accounting departments. So I'm going to throw some quizzes at you. But what I want to do is really drive home the concept of a tax home before we get into the place, or before we get into the exceptions that apply to us as travelers. So taking that definition, a tax residence is your regular place of income. Well, if you have one job, commute 30 miles every day, and come home at the end of the shift, your tax home and your permanent residence are basically the same area. Well, let's say instead you drive 70 miles and you come home at the end of the day, you commute. And this is easy. When I lived in Nebraska, people would drive 80 miles one way to get to work because all it was cows. There were no people, hardly any cars. So you would drive 70 miles, come home at the end of the day. Well, my permanent home may be different from my tax home now. But because I'm commuting, I really haven't separated those two. They're just in a wider geographical area, like a rubber band. Again, my tax home is the place and that expanded area where I'm working. My permanent home is where I lay my bed, but they're still overlapping because I'm commuting. Let's say I have two jobs. I have a full-time job. I earn $40,000 a year, and I got a part-time gig about every other week or every other weekend. I go to another city and I earn $20,000. Where is my tax residence? I can't have more than one. I can't have 2, 3, 4 tax homes. I have to find that place, which is my regular area of income. So in this case, my full-time job is the one that wins. Not only is there more money being made, but also the time and the intensity of my efforts in order to make that have to be brought into that equation too. So in this case, my travel assignment, if you will, is where I'm working and making $20,000 a year because I have a $40,000 a year part-time job. So let's complicate this a little bit. Let's say I have a part-time job where I earn $40,000 a year at home. And every month I fly out to San Francisco and I make $6,000. Well, not $6,000, $80,000 a year, but I do it 6 days a month. So I've got a part-time job. Maybe I work 8 days. I work 6 days in San Francisco, and the difference is $40,000. Where is my tax residence, tax home? Where's my regular place of business? Well, technically I have two, but I have to pick one. One trumps the other. And in this case, San Francisco is the tax residence. Even though I'm working at home, now home is a travel assignment. I've become like a professional sports player in some ways, because a professional sports player's tax home is where the team is located. Even though they may have a road game and sleep in their own bed and be in their own home, they are away from the place where they earn their money. That's the difference here. So let's complicate this a little bit more. Let's say I work one temporary job every year in Phoenix. And the rest of the year I live up north somewhere and I don't work. One job in Phoenix, no work the rest of the year. Even though I spend 9 months a year in the northern part of the US, Phoenix is my tax residence because that's the only place I make any money. It's my regular place of work, my money home. Now let's complicate it one more time before we land where most travelers are. Let's say I work 4 assignments every year, and we can conceivably do that. It's 13 weeks, right? But I make sure that on one of those, I always go back to Tampa. Every year I work in 3 cities. I don't repeat those cities, but I always come back to Tampa. Probably more during the winter, right? I come back to Tampa on a regular basis, 2 years, 3 years, 4 years. Where's my tax home? Where is that regular place of income? It's Tampa. All the other ones are random, but Tampa is consistent, cyclical, frequent, repetitive. Now, that's not how most of us work. There are the group that do that. About 5% of travelers keep a job at home. But most of the time, the other 95% work like this. On the left-hand side of the screen, you have 3 to 4 contracts a year. You're not repeating the same city, or you may like to stretch that out a little bit. And you do 1 or 2 contracts a year, but you don't keep going back to the same place all the time. In both of these cases, if you were to ask the question, where is your regular place of income? You can't answer it because there's no place to pin it down on a regular basis. So this is where the second part of the ACLS algorithm, do you have a regular place of income? You don't in these 2 cases. So then you go to the exception. So what's the exception? The exception says, okay, there's no regular place of work. You don't have a consistent location where you physically earn the income. So then, on top of that, you're not staying too long. You're not there more than 12 months. You're just constantly in motion. So if this is the case, the tax residence can default to your primary residence. That sticks and bricks home. But the qualifications for this is there, number one, that sticks and bricks main home that you have to have a financial burden for. Either a mortgage, a rent, or if you own your home, the ownership cost of that home. Rent, or whether you're renting a room from somebody, you are incurring expenses and the cost of maintaining your principal residence. And you have expenses to maintain the temporary residence where you're doing the assignment. And the IRS calls this duplicated expenses. And you may have heard that term tossed around if you talk to other travelers. But duplicated expenses is a situation where you are maintaining 2 homes, have 2 sets of expenses, 2 sets of living expenses. That doesn't have to match. It's not duplicated in the amount, it's duplicated in the transaction, having 2 homes, having 2 sets of expenses. Now, this exception is subject to all sorts of facts and circumstances. And this is where the permanent resident sort of comes in the back door. If I say I'm keeping a sticks and bricks home, you would expect my driver's license, car registration, voter registration, resident professional license all be in that same area or even that same state. You wouldn't expect it to be spread out all over the place. So not only are you saying you keep a home, but you're also keeping what most people do when they have a home, and that is all those legal ties as well. Excuse me. Now, to throw out an illustration of this, let's say Jane goes to a conference, and this is a photo from one of the travelers conventions, which I strongly encourage you to attend. So while Jane attends this conference, it's only a 3-day conference. And let's say she has a permanent job. So when she goes to this conference, if it's a permanent job, you know she's going to be going back to that place of work. So for all purposes here, she has a regular place of income. She's just gone away for 3 days in order to be at the conference. So when she goes to this conference, she has the expenses that you would expect her to find, or incur in the transportation, the lodging, the meal expenses. And of course, she has to pay for the seminar, but all of these things are employee business expenses. And there are necessary costs incurred in order to carry out your duties because she's going there to get CEUs, education. And those things are required in order to renew the license. So these are employee business expenses which are reimbursable. Remember that term? We can receive a tax-free payment for these expenses because they're necessary for us to perform our duties on the job. But more importantly, Jane's tax home has not changed. So for the lodging and meal expenses and transportation expenses, that allows it to be reimbursed to us on a tax-free basis. So let's say that when Jane goes to the conference, she runs into recruiters that convince her, hey, it's time to travel. And traveling has become, especially since the pandemic, an even greater way to enhance your skills and to practice. We don't have to be tied down to one place anymore. But let's say Jane's a little apprehensive. She's heard, well, I could get canceled or something like that. So she just says, I'm going to keep my job, but I'm going to give up that apartment, but I'm going to come back home and work on a regular basis and take some assignments here and there. So her future intent is to maintain her job. So that takes us back to the tax home analysis. Unless things change, she's going to continue to have a tax home based on income because she's going to be coming back home. So she keeps that job. She goes off on a 3-month assignment. She has the same expenses that she would have had at the conference: transportation, lodging, meal expenses. And because she's maintaining that tax home, because she's coming back home to work, she has a regular money home. All of these expenses are reimbursable, or if you're an independent contractor, they're deductible. But this is how, again, 5% of travelers work. This is how the other 95% that have a tax residence accomplish that. They quit their job. That's the whole point of traveling, right? To get out of all that politics you're getting sick of. When I traveled, same thing. I wanted the freedom to not be on every committee during the man. Quits their job, but keeps that apartment. And that's important here. Because even though now, going forward, all of these temporary jobs, we have no regular place of income anymore. But if you remember what we went through, the second part of that algorithm, if you don't have a regular place of income, the tax home can now be where it is that you maintain your sticks and bricks home. And because you have the duplicated expenses on your assignment, then the transportation, lodging, and meal expenses can either be reimbursed to you on a tax-free basis, or you can deduct these expenses. If you're getting company provided housing, that's no different from a reimbursement. And the company provided housing is still tax-free, but only if you have this tax residence situation down pat. You have to have a valid tax home in order to receive that tax-free apartment that the company provides you. But let's go to the third part of the algorithm. We already said, okay, no regular place of income. Do they have duplicated expenses? Yes, tax home's good. But what if they don't have neither? They don't have a job, they don't have an apartment that they can go back to, and they work travel assignments going all over the country. Well, now we're in a situation that we don't have all the pieces to the puzzle of a tax residence. We have really, the tax residence is wherever we go. And in this case, no home, no job, no home, regular home, no regular job. We are now what's the IRS calls itinerant. Itinerant is when you don't have a fixed tax residence. Your home goes with you. And in these situations, all the reimbursements, all the per diems, are not tax-free. Even the company provided housing, it's taxable now. If you're a contractor, now you cannot deduct the lodging, meals, the transportation, because we do not have a valid tax residence. Tax court went one step further with this and said this kind of person is a tax turtle. Sort of a funny name. Because why? You take your home on your back, and that's what a turtle does. It takes their home on their back. So to put it all in a nutshell, your ACLS algorithm, your 3-point process, do you have a regular job you return to? Bingo, now we have a tax law. If not, you go down to the next step. Do you have duplicated expenses for your home and your home away from home? Yes, we're good. No, then now we're itinerant and everything is taxable. A couple of other things to consider. Can we use mom and dad's home or a relative's home, brother, sister, even our own kids? Can we use their home as a tax home? Yes, we can. But we cannot treat mom, dad, brother, sister, daughter, son like family anymore when it comes to how much we pay. We're either renting from them at fair market value, or we're sharing the expenses that they incur for that house, just like roommates would if they were splitting things equally. We can't just give $100 a month and say we got that basement apartment in Boston, because if you were able to do that, I want to know, because I want to go there. That's cheap living, but that's not going to fly in the tax home equation, because it's looking for bona fide expenses. Other limiting factors: if I own a home and I rent it out in its entirety such that I don't live there anymore, it's not my tax home, it's a business property. I can rent it partially. I can rent it as a vacation destination like an Airbnb, but I still have to be living there, preferably 30 days a year. Either that's spread out or all at one time. Storage units, even though they're in gated communities, really fancy, huh? It's not a dwelling. You can't live in that thing. It just means you have too much stuff. Just get rid of your stuff. An RV that goes with you on your assignments, great way to travel, but if you leave behind a vacant land or vacant pad, well, you're not duplicating expenses, because vacant land, vacant pad is not something you can live in. Pitching a tent's not going to help that either. So an RV is a great second home, or you can have an RV and have a job you go back to. Remember, that's the first part of the tax home equation. Oh, maybe that Hobo Hilton might be a good place to go, but I wouldn't want to be there in the middle of the summer in Phoenix or Las Vegas. Other limiting factors, and you've heard these: you cannot be in the same place more than a year. There's another rule that we don't talk about much, and that is you can't go back to the same place 3 years in a row. Why? Because remember, a tax home is your regular place of work. These rules are there to prevent a string of temporary jobs from becoming your regular place of income. So your company is going to have a break-in service policy. They're going to tell you, well, you've been here 12 months, you need to go away before you can come back. And no, COVID did not change this, not at all. So we got to be careful about staying too long. And then the question usually arises, well, if you say I can't be there more than a year, how long do I have to go away before I can come back? The IRS attorney's ruling, or rules that the appeals agents and exam agents are to follow, say 7 to 12 months. We tell clients, don't be in the same place more than 12 out of 24 months. So prevent more than half of your income being in one location. Then commutable assignments. Folks, there is no such thing as a 50-mile rule. The fact that you drove 51 miles doesn't mean you get lodging expenses. You know why? Because you didn't have any lodging expenses if you drove home at the end of the shift. They're there to reimburse and offset the expenses. Now, why do you see that? Because your agency has to have a reasonable belief that you are far enough away to incur those expenses. But that is not a litmus test. That's only one of many tests to determine that. So 50-mile rules, just ignore them. We're really going to get down to drill down to the issue here. Do you have expenses at the assignment? If you do, then you can receive reimbursements on a tax-free basis. And then finally, I talked about those 30 days at home. Well, that's part of what goes into the abandonment rule. You can't just travel and never come home, unless, of course, you're itinerant. If you don't come home for about 30 days a year, then you can be considered as having abandoned your tax home. If you don't make it 30 in 1 year, we'll try 60 in 2 years. You have to show that home is home if you are still maintaining the benefit of receiving tax-free reimbursements or housing provisions. One word, don't orbit. Be a travel nurse, not an orbit nurse. And some people just like to just rotate, especially in the Bay Area. They go from Oakland to San Francisco to San Jose, just start the whole process. It's a big country out there. Go see it while you have this chance, because later in life, you'll cherish those memories. If I don't have a qualifying tax home, after listening to everything I said, you go, oh boy, I'm a mess now. I don't really have a tax residence. Well, there's remedies here. Can you rent with a relative? Or here's one, it's a little humorous. Find a friend that is willing to share a 2-bedroom apartment with you, knowing that you're going to pay half of it and you're not going to show up for 11 months. If that was me and you came to me with that offer, absolutely, I'd take it. I go all the parties I want to, and I don't have to worry about you showing up. But the point of this is there are remedies if you think about them long enough. But then again, there's freedom in this not having a tax residence. Then you don't have to worry about one home anymore. What is your employer, the agency? What is their obligation? They're going to give you this tax residence form. Why? In order to establish that reasonable belief, some assurance that you actually have all the components of a tax home in place before they pay you anything tax-free or provide anything for you tax-free. And oftentimes those things are going to be looking for 12 months rules, and of course, whether you have expenses at home and away from home. And I'm going to skip this slide because I've already talked about it and skip right to the very first blog post I ever had. I have a blog. If you go to our website, traveltax.com, in the upper right-hand corner, there's a blog. And way back in 2015, almost 8 years ago, when I put my first blog post up, I had this picture of a guy playing whack-a-mole. And this is what I said I felt like when I talked about the 50-mile rule that keeps bumping around. And I even took my kids to Dave and Buster's one day, and I said, boys, you want to know what Dad does all day? I took him to the whack-a-mole game, bang, 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 bang. And I said, this is what Dad does all day. They sort of thought that was cool, even though I was trying to be funny. Another thing to watch out for, one little schematic that has been floating around, and that's where you get paid 2.3 times the per diem rate for the area. This is when you're getting paid on the day, but you're getting paid this monstrous rate on the day that exceeds the government allowance. So something to be watching out for there. If you are in the military, your tax home is a little different. It is generally now going to default to where your spouse is assigned. And this is something that needs a little bit more of a workover, but the rules that everybody else follows does not necessarily apply to you if you are a military spouse that's traveling. And as we get towards the end here, what if I don't have a tax home and it's impossible and I'm just going to get taxed on everything? Well, don't take the company housing, because now you're going to get taxed on that. If that company housing is $1,000, then you're better off just taking a taxable allowance and going and find something cheaper. And then contribute more to your 401k or your individual IRA, sort of offset some of the effects of the additional taxes there. That's a lot of information. It takes a lot to digest. And you can always look us up, or if you have any further questions on this, info@traveltax.com, or our phone number is there as well, and our website, traveltax.com. And Robin, that's in the presentation.
Okay, wonderful. Just they were like maybe a few clarifying questions. So is this a great time to give those to you?
Mm-hmm.
Okay. So one of the questions was to clarify, per diem is also a stipend. Are those kind of interchangeable? Because some people have a stipend, but it's not referred to as a per diem, but is it treated the same way?
It's treated the same way because it's under the IRS nomenclature. It is
Okay.
the per diem method of reimbursement. So whether you call it a per diem stipend allowance, it falls under those rules. So it's really the same thing. Per diems in particular are lodging and meals, because you can give a flat rate for mileage, the standard mileage allowance,
Okay.
but when you're giving this lump sum, it's generally for lodging and meals.
Okay. And then the other question, let's say our viewers watching this after they file taxes, if this brings to light something maybe they've missed, what would they want to do? What would they need to do? They've already filed.
The first thing is, let's get it fixed going forward. That's probably the most important thing. And you may want to talk to a tax advisor about any other things that you may want to do, and bring the situation to them,
Right.
because
But
everybody's situation is different.
they could amend their taxes though if they needed
Yeah,
to, if they
they could.
missed quite a bit. Okay.
Yeah.
It's good to know. And then if someone owns two homes in different states, they have license in both states, how would that situation affect them?
One of them or none of them is
Okay.
going to be the tax residents. You got the same rules.
Okay.
And there are people that will randomly do assignments where they have a second home. And that's fine. That can be the second residence, but if you just keep going back to the same one each time,
Mhm.
one of them has to be the tax residence.
Okay. That makes sense. Well, Mr. Smith, we really enjoyed spending time with you and learning more about tax tips for clinicians who travel. How can attendees get in touch with you? I know you showed a screen. If they want to work with you directly, um, what should we give them on ways to contact you?
Just start with the website, www.traveltax.com, and there's all sorts of links to get you to where you need to be. And we have formal tax home consults that we do, like a 30-point question, once you spend at least 30 minutes with one of our advisors to go over in depth your tax residence. And of course, we do the returns as well too. The entire workbook, everything is right there on the website, very user friendly.
Wonderful. Okay. And so we would like to just thank you for presenting today. We hope to see you again on our webinar series. And for our viewers, thanks for watching our on-demand webinar today. Watch for upcoming registrations each month as we bring you additional tools, resources to enhance your work-life blend and wellness in 2023. Our next webinar is occurring on February 23rd at 2:30 Eastern Standard Time, when we start our self-care series with a discussion on reconditioning your relationships. Until then, take care.